All right, folks. So let's get into the topic today. What I really want to start with today is I want to actually show you guys how to do some analysis on a spreadsheet when it comes to points when you are doing a deal. So this was inspired by one of our course members. Let's see. Brandon had this question over in the financing section. So let's go ahead and jump to that. Quick note here. If you have not yet already realized or heard, I'm just gonna make a quick note. Obviously, I'm coming to 13 different cities around town, so be sure to check out when I'll be in your city. You'll see that the price shows as $299 here, but for you course members, just email me at kevin@meetkevin.com. It's $199. If you want to bring a plus one, then it's $150 for each of you if you bring a plus one. Okay, cool. Pitch over. Done. So now we're going to touch on Brandon's question here with rates. Then we'll move on to an appraiser question, and then we'll get into which is actually kind of interesting. Mark's question about appraiser blackballing, and then we'll get into some deals here. So Brandon, I want to show you folks exactly how to do this, and we've done this obviously in the lectures, but let me just give you a quick refresher here. So take a look at this. Do you folks remember this? This is right here your net present value calculation for interest rates. And so we have Brandon over here. I don't have all the details, so I'm gonna have to work this backwards. Brandon over here is showing what a lender gave him in terms of, hey, look, you could get a credit back or you could pay money. Now, a credit back, Brandon pointed out that his lender doesn't call that negative points. It's basically the same thing. When you're paying money, it's points. When you get money back, the lenders call it a credit or negative points. Every lender's different with their terminology, but let's see if we can try to rebuild what you have here. I don't have your purchase price, but here's how you guys do it. You download the spreadsheet. The way you have it, and let's just go screen for a sec alone here. You download this spreadsheet, which you could get in the loan discount point analyses, and this goes super fast because all you have to do is pop in what's yellow. So let's see here. Let me come back for a second. So we've got. I'm just going to go down this list that he has here. He's got 5 different interest rates. We're actually going to put the highest interest rate on the right, and then we'll work on over. 4.18. Wow, very small margin here in movement. 4.0. And then now we have to do the points. Yeah, okay. So I don't actually have, let's see, where's your 0 point? This is closest to your 0 point rate. See, it helps if I have the purchase price, but I might just make up my own purchase price here. P&I, let's just go 10% down. Let's just go 250 and see what I get. And then we'll go 10% down. Let's see how close we get to your principal and interest, which is right here. Principal and interest, so it's going to be a little bit more. It doesn't have to be perfect as much as I'd like it to be. Your 4% rate is 15. Okay, so you're probably, what, 375? 375, maybe 350. I bet you that's what you guys ran it at. Okay, that's pretty close. I'm just going to go with that. I'll go 360 here to be safe. Okay, so now we want to figure out the points that he's doing here. These are your sort of spreads and points. Ideally, you're able to find out where the 0 point rate is, which the 0 point rate seems to be between 1.25 here and 1.80. So you want to go between here. One of these is going to be 0, and then everything else is going to be above or below that. So below that, you are paying about, what is that? You're paying 2,000. You know what we'll do is I'm just going to break the spreadsheet here and throw in the actual amount. Don't do this. You should always have the percent. It's usually like you're getting a 0.5% back or something, an actual percentage back. So, but I'm going to cheat. 445, 45, just copying the numbers that the lenders give you. In case you're wondering, where do you get these numbers? You literally just ask your lender when you're qualifying for a deal, lender, I want options, because generally the lenders won't give you this. So you just have to bluntly ask for it. So we're pretty close here on all the numbers. Every number here is about $1, within $1 of what you have. So you must have gone like 361 or some weird number. 360. Oh, it was like 360, 500, seriously? Yeah, something like that. See, that makes it worse. So I'm gonna leave it right at 360. Okay, 10% down, that's the number you got here. Let's just double check that we've got. This is you getting money back. So if you pick any of these interest rates, you get money back. And if you pick this, one of these interest rates, you pay money. So I threw this onto the 15-year and ask questions in the live chat too. I'm gonna pop over to that in a second here. You can pick any of these interest rates. If you pick 4%, you have to pay $2,000. If you pick 4.35, you get $2,500 back. And so what we like to do is throw these on the different years worth of spreadsheets. So let's assume you held this loan for 15 years. Which one of these is your best option? Watch this, pop over here. If you held this loan for 15 years, based on this, the 4% rate would be hands down your best option because it's highlighted in green and it says that if you make between 0 to 14% on your money, always go with the 4% option. It's that simple. You don't have to worry about what all these numbers are. In fact, seriously, don't get confused by what all the fancy numbers are on the side. Want to make it super simple for you. Actually, I just saw the comment here, no love for DC. Wait for the last 3 locations, because one of them might be DC, unless it's going to be Boston. I don't know. Stay tuned. Okay, so don't get confused here. Let me go back to the screen here. Don't get confused with all these numbers. What you really want to do is you just want to, it's designed to be super simple for you. Hashtag no guarantees, don't sue me, bro. You literally take the numbers the lender gave you. You put them in here, the rate and the amount. That's all you need, the rate and the amount of the credit. Then sales price and down payment, that just calculates your savings. So what you'll see is when you take the 4% rate, you're paying more money, but you're saving $70 per month, right? So the calculator works in that it says, well, if you're saving $70 per month for the next 15 years, to get a better deal with a higher interest rate, you'd have to be able to make more than 15% on your money. Possibly even as much as 18% to be a little safer. Now I'll show you something different. So you remember in the lecture where we first talked about this, we actually used a few different tables. And then I'm going to move on to another question because I don't want to bore you with too much complication here. So let's go to, let's do a 10-year example. So I'm going to pop over 1 second. Here we go. Okay, so the cool thing is once you've filled out this table once, you take your other spreadsheet. Watch this. I'm just going to literally copy and paste this. So I've copied it. Let me just undo it really quickly since I messed everything up for my own purposes. That way I still have my original spreadsheet the way I had it. Good, let's delete that. Good. So now what you're gonna see is, yeah, it's based on IRR, exactly. So now what you're going to see is I should be able to just paste the numbers into here. What am I messing up? Oh wait, I copied them from here. There we go. I'm just going back and forth really quickly just to make sure everything here aligns. It looks like it does. Actually, the only thing that doesn't align is, see, the savings for down doesn't align. This is where copy and paste just gets dangerous. I try to save like a minuscule amount of work and I just screw it up. So let's not do it that way. Let's do it the correct way. You just retype it, Kevin. Okay, 4.125, 4.18. And what we want to see is the difference between this and the other one. Remember the other table, which said we were going to keep this loan for 15 years, said that it actually made the most sense to have the 4% interest rate. Well, before I give you the answer here, what is your expectation? What do you think? Now that we're only holding the loan for 10 years, what is it going to favor? Keeping that 4% interest rate, or is the calculator going to favor possibly taking a higher interest rate? We'll see in just a second. All right, we've got our table copied over. Everything's the same. Let's see, let's just double check. Good, this corner one should always be 0 because the highest rate should give you no savings for buy down. Then you save $23, $37, $47, $70, perfect. Last one, keeping the loan for 15 years, said that 4% would be the best. If we jump over now, look at this. So we got a little bit of a deviation here. We have that 4% still looks like the winner, but rather than going all the way to say that, hey, if you can make between this 11 to 14%, you should go with 14% or 4%. It actually says you actually have these other two options here. But notice how this 4.18 is never liked. By any table we've done, it has not been liked. Let's do one more for giggles here. Let's now go extreme. So this is gonna be an extreme example. So copy this over. This is you're only keeping, sorry, that's gonna look funky for a second. There we go. You're only going to keep the loan for 7.5 years. And we'll punch it on over real quick just to make the final point. And hopefully then you guys can all understand this. You could use it. You could get your lenders to give you this information. And then we're gonna move on to a question on appraisals, blackballing appraisers. Probably not something a lot of you are gonna have to deal with, so we'll make that quick, and then we're gonna do a deal. We'll do some deal analyses here, answer some more of your questions in the live. Okay, perfect. Type that all over, looks good, 0, good. All the savings are the same, so I typed it correctly, and here we go. Look at that. Now you have a decision to make. If you're gonna keep this loan for less than 7.5 years, you really have to decide, is it going to be better? Like, do you think you could get a higher rate of return? I mean, as high as 10%, that might be kind of tough, right? But if you kept this loan for anything less than 7.5 years, if you kept this for 5 years, the odds are your best bet is going with the 4.375 almost all day long if you're going to keep it for less than 7.5 years, which that's a nice bottom line takeaway for you. But it does show that 4% is a very strong contender in this case. So if you think you're going to keep this loan for 8 years or more, I'd probably honestly pay the money, go with the 4% rate. Especially since, once you move and that property turns into a rental, you're not going to be able to take advantage of homeowner rates anymore, so you'll have this incentive to really just focus on, keeping a locked 4% rate for the long term. Now, obviously, it's possible that values are going to go up in time, and then you might be tempted to refinance. But it gets a lot harder to refinance when you have such a low rate locked in. We have a few of our rentals that are all 3.99% right now. And I look at it and go, it's a rental at 3.99. If I were to refinance now, I would go from 3.99 to 5.125%. In fact, literally, right here, what do I have? Escrow instructions on a deal we're working on closing here within the next 2 weeks. We'll be announcing that sort of wedge deal. I like how they included the preliminary title report approval, but they didn't include the preliminary title report. So I won't be signing that page just yet. Okay, so folks, let's see what we got. Oh yeah, the appraisal question. So let's Mark over here. This is gonna be quick. Then we're gonna do some deal analysis. Ask your questions in live as well. Right now, it's always the best, fastest way for you to get your questions answered is being here in the live. Let's see where Brandon or Mark's question was. Okay, here we go. I'm just gonna share the screen for a second. Here we go. You mentioned that you blackballed a few appraisers. I'm curious as to how this works. Is this as a mortgage broker, agent, or buyer? What happened? I had an agent tell me that she talks to the appraiser to see if they are knowledgeable basically about the area, and if they don't, they request another appraiser. And somebody had mentioned that there might even be in-house appraisers. What's the scoop? So here's the thing. Buyers generally have no say whatsoever about this. So this is all going to be in the capacity as an agent. I think it goes a little bit too far when agents start interviewing appraisers like, hey, do you know this area? Like, it's kind of messed up because honestly, in my opinion, the first thing that's going to happen is that appraiser is going to get pissed. Because think about it this way. An appraiser gets assigned to a job. That's their livelihood. And then to have some agent that should have nothing to do with the appraisal process go, well, I want to make sure you're qualified in this area. It's going to piss off the appraiser, and it's probably going to lead to problems on your, I mean, I shouldn't say probably because then that means that there was like undue influence, right, in like a bad way. But the bottom line is, how motivated is that appraiser going to be to make sure your deal works when the agent is kind of treating them like the agent's an employer and the appraiser's just some applicant for a job? I think it's a terrible idea to do that. I've only in my career, out of maybe 500 appraisals, 3 times refused an appraiser. And the way you have to structure that is if the agent knows this is bad, this appraiser sucks, He is going to bomb the deal. He's got a vendetta out for me or the seller or the buyer. Guaranteed this is a low appraisal. The only times that's actually, one of the times that happened to me, the guy was on the phone with me, and let's just say he ended, and I try to be nice to everybody. I think you guys know that. I'm on the phone with him, and he ends it with, you're an effing scumbag prick. See you later. And hangs up the phone. He says that to me, and I'm like, oh, there's no way this appraisal's coming in. And so I'm like, okay, well. So what we did in that situation is we actually told, I talked to the seller. I go, look, seller, I don't know what it is. Maybe I rubbed him the wrong way. Whatever it is, he's pissed. It ain't gonna happen here. We need the seller to reject the appraiser. I don't want that person on my house. In my house. Now the mortgage company has no choice but to reassign the appraisal. But just because an agent says, I want a different appraiser, it ain't gonna happen. Just because a lender says, oh, I want a different appraiser, it ain't gonna happen. And there's really no such thing as an in-house appraiser anymore. That doesn't exist. Lenders have relationships with different appraisal management companies, and they might know a lot of the appraisers, but there's no in-house appraisals anymore, or there are none. Okay, cool. So let's answer some questions here in the live stream. Just remember, for those of you watching, I hope people watching went to 9:30. If you just joined, go to 9:30. Because the first 9 minutes, I'm going to cut those out as soon as this stream is over. I feel bad. Okay, so questions here, and then we're going to go to a deal analysis. I can fill you in on any details. The purchase price was $350. Did you get a deal, man? This is did you write the offer? This tech, Brandon, right? Okay, let's see here. Yeah. So what other questions do we have? Is it crazy how different rates? Yeah, okay, so let me say something really quickly about rates, because I had this question come up, and I think this is really important for all of you to take away. Somebody left me a comment on YouTube, or was it? Yeah, it was somewhere on YouTube. Anyway, they said, hey, what's going to happen because, what is a historical normal for interest rates? In other words, what they're saying is hey, it seems like, 4% interest rates today are kind of low. So should we, lock those in anticipation that rates are going to go back to, 8% or 10% or these historical normals? I just want you to know this. There ain't no historical normal. Here's why. The economy today is significantly more mature, significantly different labor market, which affects inflation, which affects interest rates. It's very complicated. I will be honest, I don't fully understand how it works because nobody does. I'm sure some people have a better understanding, but the bottom line is any research that you do on this will tell you that as an economy is newer, a newer capitalist economy, like what we really started seeing with the introduction of the global economy to the United States after World War II. What do you see? World War II boom, you see a lot of changes in the marketplace, you get inflation, you get higher interest rates. That's why we see higher interest rates in the 70s. We leave the gold standard. Some faith is removed. Floating dollar currency when everything used to be backed by gold. Uh-oh, did I freeze? No, I think I just lagged for a second. Okay. Okay, so, you take away all this faith from originally what is a gold-backed currency, and now you move over to this floating currency. And so you have all these changes, and what do you have? You have high inflation. I really want you to look back and look at the chart of inflation. Just look, hey, what was inflation in the 70s? Or inflation chart. And you'll see how high inflation was. And you'll actually see the chart, how it's a fight. Inflation goes up, then interest rates go up, and then inflation goes up more, and then interest rates go up more, and then inflation goes down, then interest rates go down. They kind of go together. Well, today, we could barely get inflation over 1.9%. That's because we're a very mature economy. Look at Europe. Look how mature Europe is as an economy. And they almost have deflation, which is absolutely a central bank's worst nightmare. So, when we talk about historical norms of interest rates, there ain't no historical norm. If anything is normal, it's probably what we have now. So get used to rates around 4 to 5%. Okay, cool. Other point over. So let's see what else we have here in terms of questions and chat, and then we'll do a deal analysis. Hey, unbiased opinion, absolutely. Ross Hamilton. I don't know who Ross Hamilton is, but I did I tell you this in the live stream last time? Somebody emailed me. They're like, hey, I want to pay $42,000 for a course on how to flip houses, and I'm like, oh my gosh, I need to make an exposed video. That sounds horrid. What? No. No. Education should not be that expensive. And honestly, in flipping is reliant on getting a good deal. It's all in the buy. It's all in getting a good wedge deal. But then you have to analyze, if you get a good wedge deal, does it make sense to pay all the selling costs and take all the meat off the bone, selling costs, holding costs, the over improvements, the inspections, the repairs, and all that crap? And then you're left with, usually the average flip profit is like 20 to 30 grand. And it's like, do I really want to spend my first flip's profit on a course on telling me how to flip, which should really basically just be, how do I find good deals, which is kind of what we talk about all the time. I don't know. I mean, anytime I've ever done a flip, I'm like, I really want to keep this place, because I just look at the bottom line figure at the end, and it's like, I mean, look, I've done great, very successful flips with clients. We had, I found the deal, I coordinated the deal, I renovated it, I managed the money, did everything, and probably the highest grossing flip I've ever had for a client, actually highest netting client was $90,000. If you're netting 90 grand on like a Southern California flip, take your money and run, that's awesome. But when your flip margins are like 20 to 30 grand, sometimes it's like, maybe just keep it, right? If you're even that lucky, because there's a lot of risk. A lot can go wrong then. So, okay, so do an expose on Ross Hamilton. I just don't know who he is. Okay, so go to 9:30 if you just joined. Okay. Yeah, I mean, so foreclosures and auctions, here's the thing. We talk about these in theory in the course, but the thing is, foreclosures make up 0.5% of the market right now. Yes, you can go to trustee sales where you're paying cash. So if you folks come here and you're like, hey, I got cash, I'm going to go to trustee sales, all of the same principles apply. Buy it out as a wedge. Don't overpay. Use the comp analysis. Understand what you're going to do with it. Understand the improvements. Understand the risk of not having title insurance. We do talk about that in the lectures. Have you heard about being a loan signing agent as a side gig? Gosh, I mean, I personally I couldn't do it, because a loan signing agent is being a notary, right? And then you go sign loans, you get paid maybe $200 or whatever. It could be a good gig, because if you could get those done within 4 hours, hey, that's $50 an hour, that's great. But just the amount of questions that you probably have to answer on loans, you have to be pretty educated on loan docs. And most people are clueless when it comes to loan docs, which is fine, but you as a loan signing agent have to be able to clue them in. I don't know, it would take some experience, and to me it sounds a little bit like a headache. Okay, so let's jump on over here. So we've got this question here from Mark. Okay, we're talking about this California law that's in our Senate. It's called SB 50. And basically, it would open up the door to loosen density requirements. Basically, let's put it this way. One of the reasons development is hard in most cities, especially in populous areas like California, is because let's say you buy a fourplex. Okay, let's say this composition book iPad thing here is a fourplex, and you have a lot that's right here. And you're like, you know what? This is zoned for 8 units. I want to turn this fourplex into an 8-unit building. Most of the time, you can't do jack, because the city says, well, we need 2 handicap spots and 4 spots one for each unit, and then we need a guest parking spot. And then it's like, I gotta have a frickin' parking lot on my lot. Guess I ain't building more units or more housing. And so most housing is actually stuck. And it can't expand in certain areas because of the parking issue. SB 50 in California would change that, and I want to hit this sort of with a broad stroke here. Anytime you have legislation that transforms the housing landscape, understand things are going to change. Prices are going to go up. Prices are going to go down. There's going to be anticipation of a bill passing. Prices could go up. Prices could go down. A lot is going to change anytime a new bill passes. But I want you to know this for the long run, because you could honestly drive yourself crazy analyzing all the things that could happen. Oh, what if there's statewide rent control? Oh, what if this happens? What if this happens? No matter what happens in the marketplace, this is generally the way I look at real estate. Is in the long run we have this trajectory of be that 3-4% unleveraged, right? And above above inflation is ideally the goal. But so this is long run. Say this is 100 years, okay? Anytime you have a legislation that comes into effect, let's say you have rent control that comes in, you usually just see a manipulation in values and a rebalancing of values initially. So you kind of might see something like that happen. Or maybe you see something good happen, and then you see something like that happen. It's kind of funny. It's kind of like the tax bill is the most recent example of that. The tax bill, took effect. At first, everything was great, and then the market plummeted. Except in that case, the market fell a little bit more because it left some lasting impact into reducing the benefit of home ownership by eliminating the SALT tax deductions or reducing them or capping them. In such a case, you might actually end up with something like this, and you get sort of this parallel appreciation line that actually ends up being a little bit lower. But the point is to try to predict exactly what's going to happen. Are we going to have a parallel line higher, a parallel line lower? It's impossible. Don't even worry about it. Just get into good deals is the most important part. Now, I personally think if, in response to the question, look, is there a potential to buy single family now in an area like LA that might be zoned for fourplexes or even a triplex? Absolutely. I think if you're going to hedge your bets, hedge in favor of whatever the bill is doing. I wouldn't necessarily move to a different area because of it, or I wouldn't change my overall strategy. But if I was going to look at a single family wedge deal that had no ability to be developed more because there wasn't enough lot space at all, versus a single family that I knew was an equal wedge deal, but I had the development potential, of course, get that one, right? That's the way I would simplify legislation and rules is, maybe hedge yourself a little bit, but don't over focus on it. So let's see what else we got. We've got this question here. We're and I kind of let's see, talking about this funding up. Okay, so here Brandon's got the question: do you ever think it's going to be worth paying a touch above market if you're going to have roommates and house hack? The best way, if you're going to be in a situation where you have to pay a little bit above market value, and Brandon, I was looking in your area a little bit. It might be tough for you because you're going to have to move and price a lot. But here's the thing. The best way to pay over market just because you want to get in. You're sick and tired of waiting. Your lease is up. You got to get in. You'll wait for a wedge deal a different day, but you want to get started. And you're okay paying market value or maybe a little bit above. In such a case, grab a new construction if you can. If you can get into a new construction and you get in, you house hack that. Now, yes, you're overpaying a little bit, but what are you getting in return for overpaying a little bit? 10-year builder warranty, 1-year fit and finish, 5-year, structural mechanical warranties. That's great. Talk about peace of mind, talk about simple, talk about easy way to get in. I love it. I personally happen to really like new construction. I don't like overpaying for things, but in some scenarios, it makes sense. If you're in a situation now where if you moved into a new construction and then you house hacked it and your payments were going down and you were controlling real estate, forget about it. Just get in and do it. You got yourself a new construction deal. All right. What other questions do we have here? Let's see. I read through what you and Mark, Brandon and Mark here were talking about. Okay. Warren Buffett, 5'6". We got a quote here from Ekatak. We like to buy things where the seller is making no money at all. I'm actually really kind of shocked that he said that, because I do believe in some sense that might be Warren Buffett kind of appealing to what people want him to say, because I do believe that Warren Buffett believes in win-win deals. That is, it's okay for everybody to make money, but he'll also get a good wedge deal on stocks and companies. Think about it. Warren Buffett is doing nothing different from what we're doing in real estate here, buying wedge deals. He is doing the same thing with companies. Oftentimes, a lot of that was a lot easier to do back in the 50s, 60s, and 70s, Benjamin Graham days. Yeah. So anyway, let's continue on here. So, can you share your input on this property we're considering writing an offer on? Yes, I can. Yes, check around. See, the time's gonna be messed up because I'm gonna delete the first 10 minutes. Oh well, check around 30 min in. We'll see how it goes. Somewhere around there. So let's do a deal together here, folks. This is gonna be Raleigh, North Carolina. Let's share the screen. See what we got. All right, remember, if you want to post your deals, just really the biggest thing is post your links. But if you could give me any other information, like did you get the deal? Did you write an offer on it? What are the rents? These are all extra things that are really going to help me out a lot. See, just a note, if I click on your link, you know, from a couple days ago, and then it's in escrow, but you didn't post in the deal analysis escrow spot, I'm not gonna be super excited anymore because the odds are somebody else got the deal. But did we analyze this one? I feel like we analyzed this one on Tuesday, like right after you posted it, because this looks super familiar. Oh yeah, you did. Yeah, okay, maybe you got the deal. Oh, you updated. Oh, good. Never mind. Our course member got the deal. Here it is. This is the one we actually did analyze on Tuesday. I remember it now. Look at this, folks. Our course member submitted an offer on this. We ran the comps on this. We looked at the neighborhood. We went up and down the street on this thing. And our course member got it. So congratulations. I think it's a great deal. It's got some opportunities to improve. This here linoleum, by the way, you could pretty cheaply update linoleum. Linoleum's one of those cool things. So let me just quickly say here, never mind, we did yours Tuesday. All right, let's move on to another one. And if you have questions, again, post in live. I'm going to pop back over in a second here. We got a question here. Let's see. We answered that already. Okay. Oh, here we go. So what do we got? Here's a good question. Chaz says, my aunt's, let's just screen share that. My aunt's husband died recently. Sorry to hear that. And she owns 2 homes in the Tampa area where my heart desires to move, but you're currently in Atlanta. One home is my deceased grandparents' home and has emotional ties that she finds it hard to sell, but it's not occupied. Okay, so it's vacant. My brother thinks the home needs to be condemned because the place is filthy and there are drug addictions or issues. The other, where she currently lives, is where her husband was, so she wants to sell both and move to Georgia because she's 84, wants to be around family. Is it wise for me to buy the family home and possibly the husband home for a first purchase and investment? Here are the deals. Wow. Unbelievable. Sorry, first of all, sorry to hear what you went through here. So I'm also just going to tag you responding about your dual deals around 30 to 32 min in. That's after I cut the beginning, 9 minutes and 30 seconds. So here's the scoop. The best thing, honestly, that you could do in a situation where somebody passes away is, in my opinion, Prince, your thing said message retracted, didn't it? Oh no, here it is. Okay, Prince, yeah, because your original messages got. Oh, you're okay. I'll get to you in 1 second, Prince. Let me just say this. When somebody passes away and it's a very sad time, and there is a way, there's some kind of emotional attachment to the property, in my opinion, the best thing that you could do is do a Matterport 3D scan of the property and then buy them an iPad. I'm serious, like that sounds like an oversimplification, but if you do a Matterport 3D tour and they have an iPad of their previous home, anytime they want memories of their previous home, they can open up the iPad and go to their Matterport and just like page around and look around at their previous home as a memory. To me, that's a much better memory than seeing it decay sitting empty. Right? All right. Now, as far as you buying the deals, it's very important, it's tough because it's tough with family. You want to get a wedge deal, right? But you don't necessarily want to overpay either, because if you get a wedge deal, is it now like you're robbing from family, even though wedging isn't really robbing? So the first thing I have to say is, are you sure about the location? Because the first one you linked me is right next to the 75, which is crazy busy, and then it has the 41 state freeway here, and it's got, churches across the way. It's not a super resi area, so keep in mind, is this something you want to hold long term? it seems like you're better off trying to get into the mix over here where the residential neighborhoods are, rather than here on these outskirts between the freeways. That's not to diss on your family's home, just to say, come visit me on tour when I'm in Atlanta. Yeah, see, look, I'm in Atlanta. I can meet your grandmother. Okay. That was, it wasn't planned, sorry. Then, what's this other one? Let's look at the other one. So what is this, a 3-bedroom, 2? Okay, so, well, I was gonna say I like this better, because the other one's a 2-in-1, this is a 3-in-2, it's 2,000 square feet. But look, again, this one's under the 4, and then it's on what's probably a busy street. I mean, Hillsborough Ave, not necessarily in a homogeneous neighborhood. There was definitely, I don't know. Honestly, it might just be better for them to sell and move on. And how far apart from each other are they as well? So I'm not super stoked on the location. You guys know I always start by doing this. I know these lots are big, large, single lane. What do we got? I mean, this has got to be, people have to be going 50 on this road. Here, can we see into his car? That's just my guess, based on the width of the road, the curvature of the road, the length of the road, the straightness. And I mean, look, they're selling sheds on the corner here. You know it's a busy road when they took all this effort to put all their sheds over here with a billboard. I'm not excited by either of those locations. I hate to say it. I get it, but I don't want to see you get a but just because it's family home. It might just be better to part with them. Maybe what you could do is go down there and offer to help, paint, carpet, get them on the market, get out of there. And yeah, of course, I mean, yeah, if you can get them as good deals, like Keegan says, sure, get them. But yeah, I mean, things to consider. So Brandon, you put in an offer. Congratulations. Let me get to Prince here in our live chat. And if any of you other watchers here have questions as well, be sure to post your comments here in the live. There we go. Okay, so Prince says, I'm thinking of buying a common and renting out the other 2 rooms. Do you think I will get approved for an FHA loan without a job? No. In school at the moment, so I'm waiting to get a summer job, but have a good amount of saved past the down payment and a cosigner, and my cosigner is great. Now, yes. Bottom line is, if you don't have the 3 rules of financing, job, income, and assets, you're not, or job, credit, and assets, that is, you work, you have credit, and you have money for a down payment, you won't get a loan. Now, if you don't have a job, but you have the credit and the down payment, and somebody else can qualify for you as a non-occupant co-borrower, yes, then you could probably do it. It's going to be pretty much hinge on the qualifications of your cosigner. So the other question that you had here is, and then we've got a question on an article. I'm going to pop that up. Give me 1 second. Also, my parents paid cash for it, then I could refinance. Yeah, I mean, look, anytime you refinance, you're going to end up paying more money in your interest rate. Cash out refinances cost more money. I'd probably rather see you get in with, a purchase money loan, honestly. Okay. I'm closing on my house soon. It's been a couple weeks from the analysis, just dealing with the loan headaches and the reno loan. Yeah, look, renovation, well, congratulations, first of all, getting into escrow. Glad to see that we were able to help analyze your deal. If you're doing a renovation loan, know that, yes, headaches are normal. The biggest thing is having a contractor that can get this stuff correctly lined up for you so that your HUD inspector's happy and your lender's happy. It's definitely a headache, though. You will get through it. Remember, if you just joined, don't go past 9:30. Okay, so let's look at this article we got here. I've not looked at this yet. Let's just do my reaction. We'll do a live reaction to this. How's that? New housing data warns the era of double-digit home price gains is over. Yeah, I mean, they might be right. I mean, double-digit home price gains aren't sustainable, right? It's not sustainable to go, we're getting 10% appreciation this year. Of course not. We know about this nasty slowdown, disastrous starts and permits data. I did a YouTube video on this. Well, no duh, builders aren't going to want to be motivated to build. You know, we gotta get the whiteboard out again. I love articles like this because I get triggered when I read articles. Okay, here we go. Wait for it. Here's the scoop. When the market is doing this, builders love building. When the market does this, and then this, and then this, and this, and then we're like over here is where we are now, and all of this is called Q3 to Q4 of 2018. Guess what builders think? Maybe we should wait before we commit some money to see, are we gonna keep trending up or are we gonna trend down? Of course, building starts are going to stop or slow. It's not a surprise to me. It's a realization of by the market that it's probably a good idea to just like, wait, let's see what's going on here. That hasn't stopped me from buying anything. I just bought 2 wedge deals in SoCal, so it's possible. You could do it too. Let's see. What do we got here? The weakest annual growth since September 2012. I'm not surprised. It's fine. Double top. You know, I don't do candlesticks and this kind of like chart analysis because honestly, I think anybody can look at charts like this, and I don't want to offend anybody that like does stocks or whatever, but most of the time we get an idea related to a stock, and then we get this psychological problem called confirmation bias that sets in and goes, yeah, I think my idea is going to be right because of this or this or this. So, and I mean, like, this doesn't surprise me. U.S. mortgage apps, 4-week change. Of course. I mean, this is when rates were the highest here in 2018. You can see anytime they drop, we get more. Sorry. Anytime rates drop, you get a lot more applications, and rates are much lower now than they were last year, so of course you're going to see a peak. Did they say anything particular? I can't get out of this screen. Oh, there we go. Oh, it's a JPEG file that I could click on. Is the housing market really sensitive to mortgage rates? Well, weakest growth rate, that's fine, of course. Quantitative tightening, okay, all right. Yeah, I mean, so it's an argument that's basically being made, hey, you know, I think the title is actually a proper summary, is that do not expect crazy appreciation. I agree with that. I don't see indicators of like a crazy crash coming. I think we had a massive adjustment last year, but I'm not seeing anything crazy scary on the horizon. And that could change. You know, people make fun of me all the time on YouTube because they're like, oh, Kevin, one month you're telling me the market is crashing, and then you're telling me it's the crash isn't crashing as much as it is anymore, and then you're telling me the crash is over, and now you're telling me prices are going up. Like, why can't you just make up your mind? That's like, well, yeah, because when the market does this, I say it's crashing. When I see it hit the bottom, I go, it's slowing down. We might have hit the bottom. And then when I see it going up, I tell you it's going up. That's what the market does. It's not me being bipolar. That's called the market. Okay, what other questions do we have here? So, okay. All right, cool. So, let's go through our deal analysis. I've pretty much, actually, I think I've almost answered everybody here. We got Sebastian's got a deal. Sebastian, let's do your deal. And that's going to be the last thing I've got. So if you have questions, ask them in the live right now. Sebastian, end of today's live. Interested in this property as a good wedge deal. First property negotiated to $500,000 with maybe $5,000 in credits. Still in negotiations. Much smaller houses have been sold for $550K. My guess is this is going to be worth between $590 and $600 all done. The seller is broke. You can tell by the condition of the house. Would rent for $2,900. My FHA loan is $3,200 a month. Anybody thinks this is a good wedge deal? This actually sounds very similar to a deal I just bought. Let's look at it. Of course you're in California. Which, remember, it doesn't matter where you are in the world. The principles we talk about in the course or in person at events or whatever, it's all the same. It's literally all the same. I don't care what the price is, where you are, it's all the same. So, this home is an excellent neighborhood. Oh, you know, I never read the description. Why am I starting with it? So, what do we got? Let's do the usual. You guys should always do this. Always. Maps first. Maps. Maps first. Here we go. So what do we got? You got a Dollar Tree, you got a Costco, you got a Walmart, you got a Hooters. This is good. Look, you got an Albertsons. This is nice because people like being close to this stuff, but not too close. You got the DMV right there even. Wow, it'd be painless to go to the DMV. That's crazy. You got, what is this? This looks like a nice park over here. This is, oh, you got a school and a park over here. Okay, that's cool. You actually have a smaller park right here. That's really nice. Look at that. Oh, I like that. Within your neighborhood. You got a b-ball court. Shooting some b-ball. All right, here we go. So, I really like this location. Take a look at this, folks. Do I have screen share on? Yeah. Take a look at this for a second. Look at this location. You're within a neighborhood. Look at where the busy streets are. Mission Road. Mission Road takes you into the neighborhood. You see this artery right here? I don't know if you can tell where the mouse is going. See the artery? It doesn't pass your property. Instead, the only people that are going to drive down this right here, Avenida Elana and Calle Maribel right here, those are the only, 12, 13 houses that are ever going to be on the street. That is awesome. Great place, great location within a community, easy access out via the artery, but you're not living on the artery. Excellent. Love it. Great location. So I don't know much about the city. So, I mean, I could be here, somebody could do an exposed and go, Kevin said great location. Well, this is known for a lot of crime. You guys got to look up the crime stats yourself. I don't want to get in trouble. I get in trouble enough. That's one of the things real estate agents get in trouble for is talking about crime. Nobody wants to be known as redlining a neighborhood. So, okay, I like that you actually have this extra parking on the side. This is a really kind of cute setup for the neighborhood. I really like that. And, everybody's got an older car, but I don't judge cars. Just something I'm pointing out. I do believe this has dual pane windows, though. Now, let's see. If it has the dual pane windows, that's already a good sign. Look how much data I'm getting just from looking on the outside. Look at this. The roof, don't look that bad. That ridge caps, that ridge cap up there, I mean, this is just Google Street View. This could be like 5 years old, right? Actually, yeah, see, it is. Image capture, March 2015. But back in 2015, that roof looks pretty good. Very good. I mean, I doubt it's terrible today. That's good. That's a good sign of a wedge. Look at these dual pane windows. Good sign of a wedge. Fence looks like it's in great condition. You see all these stacked blocks over here? They're not getting any money for having done those stacked blocks, but you are. That fallen fence, perfect. Keep some more buyers away. All right, let's look at the actual deal now. Wherever I put it. And then I'm going to answer some more questions here live. So I am not clicking on Zillow because I'm mad at them. I'm actually going to do another video on them soon. Okay, here we go. So let's look at the pictures. It's a 4-bedroom, 2-bath. I like it. Backyard is all concrete. I mean, you could change that if you wanted a patch of grass. Wow. I mean, yeah, talk about, like, this to me is like perfect style of a wedge because look, it just looks nasty, right? This isn't even a big deal. They probably just had a planter box right there when they had the old windows. So this is a sign of an upgrade, but it looks like problems. Original kitchen, it's dirty, it's got the saltillo tiles. I'd rip all that tiling out probably. Yeah, all this flooring, I mean, it's a more inexpensive laminate here, but yeah, I mean, these things don't match. It's a change of flooring here. This could be a good opportunity. I like this so far. It definitely has that sort of grunge feel to it, which could be very good for you. It's got the grunge feel on the inside, the original light fixtures, the flooring doesn't match, the paints are a statement, the kitchen's in a rougher shape. And this is, I mean, this could be beautiful for somebody living there, right? This could be right up their alley for what they like and the colors they like and stuff like that. But in terms of being a 2019 style HGTV home, this is not it, which means it could be a perfect wedge, especially since it seems like they spent money on some improvements here. So let's do one last thing here. What we're going to do is we'll just look at the comps really quick. Built in 76, that's good. Built in 76, copper plumbing, right at the end of the asbestos era, but that's okay. Let's pull some comps. This is our neighborhood here. And let's just do our comps together. Let's do this. Let me just go full screen here for a sec. Okay, let's look at solds. All right, so we're looking for anything around a similar square footage, which we were, 2,000? 1848. So what do we got here? On the Artery, in 2017, we have a 520 sale. That's 300 square feet smaller, and it's on the Artery Street for 520. And your deal is asking 530. I like this. Yeah, this is starting to look wedgy. I'm really liking where this is going. Let's see here. Then we have, let's see, we have, what is this? Look at this. A couple hundred square feet more, sold in December of 2018, and that's nicely remodeled with a pool. I mean, not like the most modern remodel, but it's remodeled with a pool. So, and this was 18, which the market was slower then. Market's going to be probably a little bit more aggressive then, and it's on the Artery. I'm kind of starting to agree with your value here. Let me try to see if I can find some more recent sales. Look at this, a 540 sale, and it's only 1,300 square feet. My gosh, that's awesome. Good. This I like. What is this? 1,200 square feet, 1,200 square feet, 1,200 square feet. Here we go. This is a lower one. Oh, but it's on Mission Road, of course. Crazy busy road. Here, what do you have here? This is a 550. Well, let's look at this. Yeah, but sold a year ago. Now, the market may have softened a little bit since then, but here's an example. Oh, but it was a foreclosure. The foreclosure sold for 551 a year ago. This is a good deal. I like it. Let me say it more clearly. This is a good deal. Buy it. If you can get it for 5, it's a really good one. I like that. I mean, you're not going to be able to turn around and flip it because the selling costs are so high in California, but I do like that a lot. Now, let me go back to the live chat here and see if there are any other last-minute questions here. So that was a really nice one. I really like that. So they had 0 interest besides us. It's a good city. 5 people showed up at the open house, including us. There's no asbestos or lead in the paint. Hey, man. I love it. I love it. Go for it. Don't care about the open house. Care about offers. Open houses mean nothing. I'll tell you, I hate open houses. I love open houses as an agent to get clients, but don't feel competitive because it's an open house. Half of them were probably neighbors, and the other people probably don't even know what a pre-approval letter is. You're in a good spot. Buy it. Write an offer. I want to see you in escrow on that place. And see what you can get. So congratulations, folks. Thank you for sitting through another live stream. I got to cut out the first 10 minutes of it, but oh well, it happens. Thanks for being here. Appreciate you all. Do make sure, as sort of a final little go away, to check out when I'll be in your city. Know that I'm announcing 3 more locations here, but then go shopping. Email me for your coupon, and you'll be good. See y'all, folks.